China's economy expanded by 5.2% year-on-year in the first 3 quarters of 2025, beating expectations. This stronger-than-expected performance was largely driven by robust external demand, with net exports contributing 1.5 percentage points to overall growth. However, November's manufacturing and non-manufacturing PMIs remained below the 50 mark, reflecting spillover effects from the weak property market. This reinforces our view that growth will likely slow further in the fourth quarter to below 4.5%. That said, China is still on track to meet its full-year growth target of around 5%, and we forecast GDP growth at 4.9% for 2025. Looking ahead to 2026, we expect growth to moderate to 4.7%, weighed down by an uncertain consumption outlook and a smaller boost from external demand. While the M1 growth has rebounded on the back of improving equity market performance, household loan demand remains subdued. In fact, new yuan loans to the household account for only about 5 to 7% of total new lending in 2025, lowest on record, highlighting the persistent weakness in credit appetite and its drag on consumption recovery. On trade, the US and China extended their trade truce for another year in early November, a sign that China's escalate to de-escalate strategy is paying off. Both sides have strong incentives to keep tensions manageable, reducing external uncertainty in the first half of 2026. Still, weak investment and consumption will likely cap the pace of recovery. The recent optimism in equity markets is encouraging, but it won't fully offset the negative wealth effect from a fragile housing market. On policy, China has laid out its economic goals for the next 5 years under the 15th Five-Year Plan. We expect the 2026 growth target to remain around 5%, but achieving this will require additional policy support. The PBoC is likely to maintain a wait-and-see approach for now, though we see room for a 10 basis points cut in the 1-year loan prime rate next year. Importantly, the new 5-year plan explicitly calls for a significant increase in the household consumption rate, signaling a shift towards the demand-side reforms. Measures such as staggered leave systems and cash handouts could potentially boost spending. Meanwhile, capital markets are set to become a new engine of the household wealth growth. As shareholder interests increasingly align with national priorities, the evolution of China's capital markets in 2026 will be a key development to watch.